Listen up. You're throwing your money away. I don't care if you think you're being smart with that new crypto coin or that stock tip your cousin gave you. You're doing it backwards, and it's costing you thousands of dollars every single year. Eliminate high-interest debt first. Step 1. Kill your high-interest debt. And I mean kill it. If you have credit card debt charging you 24% interest, paying that off is your investment. It's a guaranteed 24% return. Let me put this in perspective. The stock market averages about 10% returns per year over the long term. Your credit card is charging you 24%. You're literally losing 14% every year by investing instead of paying off that debt. There are two ways to attack debt. The avalanche method means paying minimums on everything and throwing extra money at the highest interest rate first. The snowball method means paying off the smallest balances first for psychological wins. Pick one and stick with it. The average American has $6,000 in credit card debt. At minimum payments, that takes 32 years to pay off and costs over $11,000 in interest. 32 years. You could have paid for a car with that interest money. Build an emergency fund 3 to 6 months. Step 2. You need an emergency fund covering 3 to 6 months of expenses, not 3 to 6 months of income. Expenses: if you spend $3,000 a month to live, you need $9,000 to $18,000 sitting in a boring savings account, earning boring interest. Here's a stat that should terrify you. 40% of Americans can't cover a $400 emergency without borrowing money. 40%. That means almost half the country is one car repair away from going into debt. Because here's what happens when you don't have this fund. Life hits you. Your transmission dies. You get sick. You lose your job. And suddenly you're forced to sell your investments at the worst possible time just to survive. You're selling low when you should be buying low. Keep this money liquid. High-yield savings account. Money market account. Somewhere you can access it immediately without penalties. Don't invest your emergency fund. It's insurance, not an investment. Capture employer retirement match-free money. Step 3, get your full company 401k match. This is free money. Free money. If your company matches 50% of your contributions up to 6% of your salary, and you're not contributing that 6%, you're leaving money on the table. Let's do the math. You make $50,000. You contribute 6%, that's $3,000. Your company adds 50%, that's $1,500. You just made a 50% return instantly. Show me another investment that guarantees 50% returns. 22% of people who have access to a 401k don't contribute anything. 22%. They're walking away from free money because they don't understand how it works, or they think they can't afford it. Here's what that costs you. 2 people start the same job at 25. One gets the full company match, one doesn't. After 30 years, the person who got the match has over $200,000 more. Same job, same salary, different choice. Invest in low-cost index funds. Step 4. Now you can start real investing. And I'm going to save you years of mistakes right here. Buy index funds. Boring, diversified, low-cost index funds. Here's a stat that will blow your mind. Over the past 20 years, 85% of actively managed funds failed to beat the S&P 500 index. 85%. Professional fund managers with teams of analysts and billion-dollar budgets can't beat a simple index fund. The average actively managed fund charges about 1.5% in fees. A good index fund charges about 0.05%. That difference compounds over decades. On a $100,000 investment over 30 years, that fee difference costs you over $60,000. Invest consistently, every month, same amount. Don't try to time the market. Don't panic when it drops. Don't get greedy when it rises. Just keep buying. The market has never failed to recover from a crash if you give it enough time. The S&P 500 has crashed many times. 1929, 1987, 2000, 2008, 2020. Every single time, it recovered and reached new highs. Every single time, the people who stayed invested came out ahead. Invest in real estate or REITs. Step 5. Real estate. But only after you've done everything else. Real estate isn't magic. It's not a get-rich-quick scheme. It's another asset class that can build wealth over time. Over the past century, real estate has returned about the same as the stock market when you account for maintenance, taxes, and vacancy. The difference is, real estate requires more work, more capital, and more risk. You can invest in real estate without buying property. REITs, real estate investment trusts, let you own pieces of commercial real estate without dealing with tenants, repairs, or management. They trade like stocks but invest in buildings. If you buy rental property directly, understand what you're getting into. You're not just an investor, you're a business owner. You'll deal with tenants, repairs, vacancies, and regulations. It can be profitable, but it's work. Build additional passive income streams. Step 6. Now you're building multiple income sources. Dividend-paying stocks, rental income, royalties, business investments. The goal is money working for you while you sleep. The wealthy don't rely on one income source. They build systems that generate cash flow automatically. Warren Buffett makes millions from Coca-Cola dividends alone. He bought the stock decades ago, and it pays him every quarter without him lifting a finger. Think about creating digital products, investing in dividend aristocrats, or building a side business that can run without your constant attention. The key is scalability. You want income that grows without trading more of your time. Most people work for money their entire lives. Rich people make money work for them. There's a massive difference between earning a paycheck and building wealth-generating assets. Diversify into international and alternative assets. Step 7. Once you've built a solid foundation, you can start diversifying globally. International index funds, emerging markets, commodities, precious metals. The US stock market represents about 54% of global market capitalization. That means you're missing out on 46% of investment opportunities if you only invest domestically. International diversification protects you from country-specific risks. If the US economy struggles, other markets might thrive. During the 2000s, international stocks significantly outperformed US stocks for several years. Alternative assets like commodities, gold, or cryptocurrency can provide inflation protection and portfolio diversification. But remember, these should be a small percentage of your total portfolio. 5 to 10% maximum. Reinvest and compound wealth. Long term. Step 8. This is where the magic happens. Compound growth over decades turns modest investments into massive wealth. Einstein allegedly called compound interest the eighth wonder of the world. He said, those who understand it earn it, those who don't pay it. Whether he actually said that or not, the principle is absolutely true. Start with $1,000 following this system. Add $500 a month. In 30 years, assuming average market returns, you'll have over $1 million. That's the power of doing things in the right order. But here's the key. You have to reinvest your gains. Don't spend your dividends. Don't cash out when your investments grow. Let that money compound and grow exponentially over time. The difference between someone who invests for 10 years versus 30 years isn't just 20 more years of contributions. It's the compound effect of those extra 20 years that creates generational wealth. The wealthy don't get rich, from hot tips or secret strategies. They get rich from boring, consistent, long-term investing. They buy assets that produce income and appreciate over time. They avoid debt. They live below their means. The hardest part isn't the math. It's the discipline. It's saying no to the shiny new investment everyone's talking about. It's sticking to the plan when it feels boring. It's trusting the process when your friend brags about their latest crypto gains. But here's what your friend won't tell you. For every crypto success story, there are 10 people who lost everything. For every stock picking winner, there are dozens who underperformed the market. The system works because it's designed to work for normal people with normal discipline. Follow this order. Build your foundation first, then build your wealth. Don't skip steps. Don't get fancy until you've mastered the basics. Your future self will thank you for being boring today. If you found this helpful, make sure you hit like and subscribe. See you in the next video.